So we went over the individual, some of the most common trading technical analysis um, tools. And what I want to do today is to combine them all and apply them to an example, and then we're going to move on to how we can do this for a pair of currencies or an exchange rate. And so what I have here is the Trading View, as we always do, and it's a great website, free of charge, and time to time get ads. But so I have the S&P 500 index, the SPX, and I'm actually going to look at a 1 year term, and just make sure that this is on a daily. Remember, when we talk about, say, a moving average, it's a moving average based on the closing of the selected frequency. So if our frequency is daily, then you actually have a moving average that's on a closing of the day. But if you have it as, say, 15 minutes, then this literally is a 15-minute periods and the closing of an individual 15 minutes. So it's important that we actually, set our chart to a daily frequency, and I usually go for 1 year. And so, what you're looking at is the candle chart, and we can actually choose different charts. A line chart, in my opinion, is very limited in information. It only gives you the day's closing, and it goes from closing to closing. And I'm not sure if it actually is. It's one information per day, so it's limited. I do choose the candle, and hollow candles and the bars are work the same, but it basically gives you 4 information points for each day. You have the open, the close, high, and the low. So having had that many information, I usually appreciate looking at how big the charts are or how big the candles are and how that size of the candle change from one day to the next. So for instance, if you look at, say, right here, you have a little bit of candle and not much of a change during the day, but when you look at the next day, you have a huge candle. So today, for instance, we had a red candle and it was a bad day. We basically just opened up at the high of the day. And let's look at it bigger. We opened up at the high of the day and we closed barely above the low of the day. So it was a bad day. It was a good day for bears. And so you follow how we actually had multiple days very similar to today recently. So, and then the bulls try to take it a little bit, but kind of failed overall. So, I think the candle chart compared to the line chart is a lot more informative, and it provides us with a very good, um, you know, day-to-day change in daily or intraday activity. So next, I'm going to include a moving average for this. And I want to do a simple moving average, and I want to do two. So the first one, I'm going to actually make it a 50-day, and let's make it, oh, say green. And then the next one, I want to make it a 200-day, and let's make that red. And this is 200. Now, obviously, the 200-day will be flatter because you have a longer period to average the closing days. And, we have right here a golden cross. We perhaps talked about this in the class, but a golden cross is when you have a 50-day that breaks above the 200-day, and that usually, means, or people usually take it to mean a good indication of the market sentiment. And so we have a golden cross. And if you actually have it just the opposite, like we have it right here, 50-day kind of breaks above, two below, off the 200-day, and we call that a death cross. So, that's when, the short-term sentiment becomes worse than the long-term sentiment. And usually people take it to mean. as a bad signal, and that's called a death cross. So there's nothing good about it. And then this is the golden cross, so that usually means good. So notice how recently we've been above that 200 day. So I think that from that perspective, we were kind of due for a mean reversion, and we've been having that with respect to 200 day. And I think today we kind of sagged below that 200 day, and but it's all within that healthy mean reversion, as far as the 200 day simple moving average goes. And with respect to the 50 day, the deviation from this is usually not as big as the 200 day, but we also had quite a big expansion out of that 50 day. And then there's an oscillation around that 50 day. And then we actually sagged below. We try to revert to the mean. We're now actually sagging below that 50 day. So in all expectations, I would have said that with respect to the 200 day, we are right at that mean. With respect to the 50 day, the short term expectation, we are a little bit oversold. So, again, our job is, remember, with this video, I'm just trying to give you a summary of the report that we would write if we were to do a technical analysis report. And our job is never to fortune tell. I mean, you really cannot tell what's going to happen to the price. And I think that if anybody is telling you that it's going to go up or it's going to go down, and this says it will go up, I think that it's just misleading, simply because if people knew it so well, why would they tell you? And if people knew it so well, why wouldn't they actually trade on it and would need your attention or your money to tell them that it's going to go up? Anyhow, so what we do usually is, we go tool by tool, and then what signal and what interpretation that they provide to us. And then obviously you can have conflicting signals from one tool to the next. So I think the first one that I would say is, since the beginning of this year, we are at a golden cross. So that usually is a very positive. But that was almost 10 months ago. And, you can see how that 50 days coming dangerously close to the 200 day, and we might actually come to a death cross, and that would mean bad. So our number one to write to our report is that we had a golden cross since the beginning of this year, and that's usually a positive signal. We had a deviation from the 200 day, and recently that deviation reverted to its mean, and therefore we are within that 200 day average. That's it. There is no signal with a 200 day moving average. And then with respect to the 50 day, we are now oversold, which would mean that from a short-term perspective interpretation, we would say that we are oversold. So golden cross, good thing. 200 day, right at the mean. And then 50 day, we are oversold. So let's take a look at others. And I'm going to remove these moving averages. And I'm going to include the RSI. We're just checking to see what other signals we might have. And notice now that the purple line for today, or for recently, we might be close to that bottom line, but we are not. We are within that 30 to 70 range, and therefore there is no RSI signal, and therefore RSI is not an indicative technical analysis tool for us. So let's take a look at the others. Let's look at the Bollinger Band. So with respect to the Bollinger Band, we are now right at that lower band, and that might actually mean usually that the Bollinger Band does not have a signal yet, but we are very close to one. And if anything, we would say that we are at the we are a little bit oversold. But remember, I'm going to change the length of the moving average. Usually it comes with 20, but I want to do 50, which will look very similar to the 50-day moving average. And based on that 50, we actually, as of today, we actually just broke below the lower band, which means that we have now a oversold signal as far as the Bloomberg Bollinger Bands go. And again, it doesn't mean that it's a buy signal, but it simply means that perhaps going down a little bit more may be harder. Having said that, funnily enough, right, you have multiple days that actually just keep breaking that bottom line. And therefore, we might actually continue with that. But like I said, technical analysis is something that you actually take under consideration, but it should not be the main decision maker for your trades. And I don't think that any robotic rule can give you any reliable information consistently. That would violate the market efficiency. And furthermore, if it was so easy, then everybody would do it. If you think that you're the only one looking for this pattern searching, then you're mistaking. Everybody's looking at this. But on the other hand, we believe in the financial investor behavior. And if enough people believe that the market is oversold, then it might be that market becomes oversold as self-fulfilling prophecies. So, it's not a sole tool to decide whether you should buy or sell, but it is one of the variables in your decision function and in your criteria. So as far as the Bloomberg Bollinger Bands go, we actually have an oversold signal. So let's look at another one called the Fibonacci. Now, with Fibonacci, I think I'm going to go back to a little bit more. And obviously, we can do a few different lengths. So one of them, I can actually go all the way back to 2020, the beginning of the COVID, and then see where we are. And then perhaps I could go another one. So remember, with the Fibonacci, you're basically looking at a recent, fast, either ascending or descending price pattern. So I would say that this is definitely a price ascension. And then if you look at this is definitely another one. So let's take a look. And, if, obviously we could also look at this ascension, but there's enough recovery right here that I think that that's actually fulfilled. And again, with the Fibonacci, what you're looking at is like a table tennis ball. When you actually throw the ball, the action is that the ball goes down and then, or, the ball goes up, and then you have some sort of a retrace. And at one point, the ball actually stops. So the Fibonacci combines an art and a science. And the art of it is to know where the ball has been drawn. And then, and also the art of it is to know that where that ball actually stopped and a new motion have begun. So I think I'm going to go, and again, it's not an exact science. I think that it is an art and a science. And I want to go through with this simply because, I think that as far as the S&P 500 goes, this ascension is still not fulfilled completely. So I'll go, remember what I did is right here, I chose the Fib retracement, and that's your Fibonacci. And then I went from the bottom, and then I went all the way to the top right there. So now remember, with the Fibonacci, what you're looking is not a direction per se, but where your resistance and your support lines are. So once we start from 2194 all the way to 4816, that's actually about 100% return. And from that return, we started to descend, or we start to retrace. The first line is the red line or red area, which is the 23%, and it actually corresponds to that line. And now notice that we actually hit that line, came back down, and then came back up again, and then we kind of sagged below that first defense or first support line. The second support line is at 38%, and notice how we're oscillating around it. It's so much so that in June, we actually sagged below it briefly for a few weeks, and then we recovered all the way back up to the 23% support line. And then immediately after, we actually sagged and broke below that, and now we are at the 50%. 50% actually is not an official um, Fibonacci. I think it goes 23%, 38%, and 61%. At no time we're actually at a 61%. We haven't even got into that area at all. So I think that motion is now a little bit over. So, but again, I mean, it's just my opinion, right? I think that at 50% is a good support in that 3,500, which also is quite a round number, and people seem to like round numbers. If that is that perhaps can be a behavioral technical analysis to round numbers, rule of round numbers. And notice immediately after we hit the 50%, we climb back up above the 38. Then which support became resistance, and then we came back. You see how this actually fits so nicely that we have oscillation within that range, or what people refer to as a range-bound trading. We are captured within that range of 23% and 38% of the retracement. And then we break above, and then we just simply are back at that 23%. So, if you look at today's trading, honestly, what happened was we are just at that support line. 4180, 4190 seems to be a very, common. I don't want to say it's strong because we have actually broken it before, but a familiar support line, and we are yet again visiting it. So that's why I think that the long-term Fibonacci from the COVID all the way up to the Fed interest rate or monetary policy change is still intact. It's still in play, and therefore I think that we still have very familiar support and resistance lines as far as the S&P goes. So let's remove this, and then let's draw another Fibonacci for the short-term ascension of the price. So let's go with the very bottom right here. This was the 50% retrace from the long-term COVID Fibonacci. And notice now, this also fits quite nicely. I mean, not to brag, but talk about being artistic, right? I mean, just when you fit your Fibonacci and then it actually fits this nicely, I think it makes you feel that you've actually chosen a right time period and that the market is kind of fitting your expectations. And, I think the more important part of it is that you have to follow the market consistently and have an idea of when the breaking points of the market perspective, investor perspectives are. So self-bragging ends, and now notice how we have this price going from about 3,500 all the way up to 4,600. And notice along these lines, we actually had some time right about here that it actually took us time to break above that resistance line. So, and then we went all the way up to 4,600. And notice how we immediately retraced back to the 23% support line. We have an oscillation, and then we came back down again, and now oscillated again a little bit, and then we're back up to 23%, and now we're back down to 38%. I mean, there is no rule that says that this cannot break below 38%. It can easily do. We can just go wherever. Again, remember, with Fibonacci, we are not really saying that the price is going to go one way or the other. We're talking about the resistance and support points. So having said that, the 38% at 41.82 was actually a very strong resistance line. And I think that this might actually become a support line. We might spend some time around this, or at 44,051, we seem to have a lot of oscillation around it, and that might actually become what some people refer to as a magnet, that it might actually, attract the price down to 4,050 level. And again, 4,000 is a round number, and people seem to like round numbers. And but if I were to, say that what our resistance and support points are, I would say that a definite support point is at 43.45, which we broke. And then the second one is right about now, 41.80s. And then the next one would be 4,050s. I think the next one, again, based on the Fibonacci, is 39.20s. So having said all of this, remember with the 50-day, you're oversold. With a 200-day, we're right at that point, the mean, reverted mean. There is no RSI signal. Bloomberg, why do I keep calling it Bloomberg? Bollinger Bands say that we are a bit oversold at 2 standard deviations. And the Fibonacci says that we are now right around that, one of the stronger support points. So, take it for what it is. It just simply says, these are indicators, and based on the 200-day, which kind of negates all the others, we are right at that mean, and we could sag more. But the others seem to believe, or the others seem to indicate that the oversold, perhaps the market's perspective can become a self-fulfilling prophecy. So, having said that, let's do a simple yet another. Let's do a non-market on Apple. So perhaps Apple was not a good choice simply because it's very similar to what happened to the overall market, right? So let's do very quickly. If we do moving averages, simple moving average, and another one. And remember, we're going to do 200 day. So 50 day. And I want to do 3. And then we'll do 200 day. And then we'll go back. That's it. And again, notice right here, you have the golden cross. We are right at that 200 day. We are a little bit oversold on the 50 day. Again, Apple is very large company, and therefore its influence on the market is undoubtable. And therefore, finding technical analysis indicators that are very similar to the indicators for the overall S&P 500 is unfortunately inevitable. So I think if you were to look at, say, individual, perhaps smaller companies, let's say American Airlines, things might change a little bit like this. So notice we have a golden cross, death cross, golden cross, death cross. So, and American Airlines just crossed the death cross on the end of September, and they're on a downtrend. And it's just, I think this might be more interesting of a company to evaluate. So at this point, we have a death cross. That's usually a very, it makes people to believe that this is not a good sign. So let's remove these and then take a look at the Bollinger Bands. And I bet this is going to be, yep. So we are right at that lower band, although with the given 20 day, there is no really a breach. So what I'll do is I'll flip that say 50 day with a 2 standard deviation. And I think we're going to have, oh no, you see, again, we're given the 2%, 2 standard deviations. We don't really have a breach of the lower band. We are right at that level of a breach, but given the rules of the Bollinger, we don't really have an oversold indicator. So let's take a look at very simple, the RSI. And our RSI, like I said, it's very, very simple. And now, we now have an oversold on the RSI. You see how the RSI now is an indicator, but the Bollinger Bands is not. But we actually had a huge oversold, and we continue with the oversold. And I think this is a good example of how an indicator, even though it's actually giving you an oversold signal, it's actually not correcting itself. The metric itself is correcting, but the price is not. So even though it's oversold, it's actually still continuing to go down. It was oversold at around $13 and now it's at 11. If you were expecting a correction because the RSI, which is very, very easy and therefore expectation of self-fulfilling prophecy would be at its maximum, still, even though we have a signal, there is no correction. So with respect to the Bollinger Band, the Fibonacci, so there is really no motion and it ends to be able to draw a Fibonacci, meaning there is a motion here which we can draw, but it would only give us, what we can do in the future. And because the retrace movement have not started, it wouldn't really give us anything. Meaning, if American Airlines were to start to correct itself and the price starts to go up, then you would expect the first resistance at 12.87, or I think to be more round numbers again at around $13. I think that would be a very strong resistance, and then another one 14, and this kind of fits nice. Look at that, all at around these round numbers. $13 is the first resistance, $14 is the second, 15 is the third, and approximately 1550 is your fourth resistance points. So our idea is to do an exchange rate. So another issue, sort of say, for instance, for dollar Turkish lira. This again is an example that we cannot unfortunately draw a Fibonacci. And so, there's the fundamental side of things, which we're going to talk next week. But from a technical perspective, unfortunately, there really was no Fibonacci that I can draw for this. But if you look at, say, dollar euro, which again, remember, you cannot do for your assignment, and I'm going to do 1 year. Let's include the moving average, so a simple moving average, and again, 2 of them. So let's go with a 50-day first with green. And then let's do the 200-day with red. All right, so now notice again, we actually had a golden cross right here, and we recently crossed a death cross. But remember, this is an exchange rate, and therefore, when we talk about golden cross and death cross, we're talking about the golden cross, death cross of the exchange rate. Meaning this is a death cross, which means the exchange rate is probably expected to go down, which means the dollar is gaining in value, right? Because this is how many dollars you pay for each euro. So perhaps what I could do is I could just look at in indirect quotation and look at USD euro, which would mean just like this. Now it became death cross right here, golden cross right here, and this price going up, which simply means that the dollar is gaining value. So in this sense, now that we are oscillating about that 200-day, and we have been trading significantly lower than the 200-day for a very long period of time, and recently we actually recovered above and beyond that 200-day, and we are now a little bit overbought, right? And with respect to the 50-day, I think we were a lot more closer to the 50-day than we were to the 200-day. So the short-term perspective with respect to the dollar euro has been a little bit more closer to its reality, and that the price has been oscillating in close proximity to the 50-day, and currently it's almost right at that 50-day moving average. So with respect to 200-day, we're a little bit overbought. We just had a golden cross, which is a good, but the 200-day overbought usually is a bit negative. And in the 50-day, you're almost right at that mean or average level. So let's take a look at the Bollinger, 'Bands. So, now notice again, we actually had a golden cross right here, and we recently crossed a death cross. But remember, this is an exchange rate, and therefore, when we talk about the golden cross, death cross of the exchange rate, meaning this is a death cross, which means the dollar is gaining value. So And I want to look at particular again. Now, we are right around that mean, which we kind of knew before we did the Bollinger, but notice though that whenever we actually break above these ranges or below these ranges in the dollar euro, it seems to actually correct itself. So compared to the stocks, I think that this is perhaps a little bit more in favor of the Bollinger Band technical analysis tool. But when you see a breach of an upper or a lower band, there seems to be a bit of a correction, but it may be specific to this time period. So we are right around that mean, and currently we are neither above or below that range, and therefore we don't have a signal as far as the Bollinger Bands go. Let's do an RSI, and then see if we have any sort of, and no, we are almost right in the middle of the RSI, and therefore we had an overbought signal recently up in middle of September, towards the end of September, but now we're right in the middle of the RSI, and we don't really have any signals. And with respect to the Fibonacci, we might actually do, like we did for the S&P, perhaps, yeah. So let's go with this one right here, right? So if we actually go with a Fibonacci from the bottom of this movement all the way up to this movement, yeah. So notice that 0.90 is right at that 61% level, which usually refers to a inversion. So, I mean, we had that. I mean, see, the first support did not even hold for a day. It was easy to break. The second support, just as much. And then the third at 50% seems to be a very strong point. So you're looking at 0.90 euros per dollar to be a very strong support and a resistance, actually. But then when we go down to 0.90, you have a strong support right here. We broke it for a few days, couple of days, but it looks like the response of the markets was strong, and it actually snapped us back to the 95 level, 0.95 level. So I would say that that reversal of the of this trend by breaking the 61% is quite possible. It's just the market reaction when we reached that 61% was decisive. So I would say that at this point, the price actually breaking below that 61%, while it's likely, it may not be as, strong, but we'll see. And so, currently, like I said, with the Fibonacci, we're looking at the resistance and the support lines. I would say the first support line that you see is 0.9290, and then the second one, 0.90. So anyway, next week we'll start talking about the fundamental analysis, and then we're going to combine the technical analysis with the fundamentals, and then start doing our exercises with respect to these currency technical analysis tools. But remember, if you choose a currency, say dollar Turkish lira or euro Turkish lira, I mean, this will make your job harder simply because this is not this is a decisively using currency, and there's a difference between a good analysis, and then you have to understand that this is still a lecture, this is still an assignment, and therefore, you have to choose a currency pair that makes your life easier, that makes your analysis a little bit more relevant to an actual exercise. Drawing a Fibonacci for this and saying that you don't have any Fibonacci, lines, it does not serve any purpose. The idea is to learn this, not just get it over with. So please choose currency pairs that have some volatility that looks, perhaps with, a little bit of a meaningful technical trading or, technical analysis tools. So anyways, thank you so much for working with me, and I do hope to see you all soon. And if you have any questions, please do let me know. Have a great day. Thank you. Bye now.